but then they sort of shrug their shoulders and say, yeah, but I don't really need it because the government's got my back, and interest rates will never ever go up again in my lifetime, and if the market ever goes down, the government will rush in to save it.
So going back to what you're saying about how a lot of clients just don't think that they need the insurance policy right now, how do you respond to them?
Well, again, I mean, there's always uncertainty in markets, and the idea at some point that a Fed put doesn't get priced in would seem to be a little bit at cross purposes with the whole idea of efficient markets. I mean, the idea of efficient markets is that what we know is priced in. And right now, everyone knows that the Fed will never let them lose money. And as I said, that may continue, but that's a very dangerous assumption for market participants to have. Because if anything changes that viewpoint, Scarlett, everybody's going to rush from one side of the boat to the other.
Yeah. How much harder is it then to get these institutional investors to commit a significant amount of capital in the last 4 years then?
Well, as I say, it's been difficult for every short seller, including us, in that no one thinks they need insurance till their house catches on fire. And generally speaking, the fundamental short side over our 35 years, which you mentioned, has been able to generate returns even in anything but really rapidly rising markets. And so this is in a unique environment since Christmas of 2018, in that we've seen not only the central bank easing, but we've seen a return of retail speculation.
Yeah, absolutely. What's your batting average on your short position since Christmas of 2018? And how does that compare to what it was, for instance, when you first started the firm?
Yeah, well, normally, I mean, we're right on about 2/3 of our positions, sometimes as high as 70%. And I would say that the opposite has happened now. I haven't looked at it recently, but I'd say maybe we've been right on about 1/3 of our positions and wrong on 2/3 price-wise.
You mentioned retail traders. Let's talk about that, because it's not just the Fed putting a floor under asset prices. Retail traders are bidding up everything, especially companies linked to the reopening trade, cruise line operators, restaurants. And I know you've been skeptical on those kinds of companies. Will these companies' business models buckle when the economy does start to normalize and perhaps government stimulus will start to be withdrawn?
Yeah, so we're not short the restaurants right now or cruise line operators, but we are short a number of businesses that I think have changed dramatically, and we're basically beginning to show signs before COVID of weakening trends. COVID accelerated them, and now they've caught a bid because of the reopening trade. But if you look at the businesses and try to value them based on where they were in 2019, pre-COVID, or even 2022, post-vaccine, the valuations make no sense. And that's what's so interesting, because a lot of them have lost a lot of money and have taken on debt or issued equity to get through the pandemic. Their capital structures are much different than they were in 2019. And so in many cases now, if you look at Las Vegas casinos, for example, they're at all-time record valuations relative to their cash flows. And I mean cash flows out a year, not 2020 cash flows.
So you tell a compelling story, but the other side can tell just as compelling a story as well. And we know that we're kind of in a post-truth environment, as you called it, where my facts are your fake news. And people believe what they want to believe. How much does that get in the way of your short thesis playing out when people will just continue to bid up stocks because maybe the valuations are out of whack, but it can continue to be out of whack for a long time? It's
one of the more odd, bullish arguments I hear, in that, yes, people can believe nonsense for a long time. And I said, well, you know, if you're at a poker table, you want to see people with lots of money doing really dumb things with their cards. And you know, if you're playing poker properly, and you want to be in the marketplace, you know, betting against people doing really dumb things with their money. Right now, people are doing really dumb things with their money. It can go on for a while, and you can lose lots of poker hands to people that are doing dumb things with their money. But over time, I would hope that basically, if you're playing properly, you're going to come out ahead.
Are people doing dumb things with their money when it comes to the big mega cap tech stocks?
A lot of the big cap tech stocks are pretty good businesses. I mean, if you look at the businesses, if you look at an Apple or you look at a Google or even a Facebook, whatever your politics might be on this, and there certainly are risks, but they're very, very high return on capital businesses. Most of them see their profits in cash. I mean, we have no quarrel with that. And so if they trade at 20 times cash flow or something like that in a market with lower interest rates, yeah, that certainly might be an appropriate valuation. I don't know, but that's not where, that's not the pool we're swimming in. And I think that there's lots of other businesses that aren't great businesses that have gotten inflated valuations.
Would you short some of those big tech names because of possible regulation?
I don't think so. I mean, that's hard to. There are some interesting regulation plays, I think, out there with the new administration, but I don't think big cap tech yet is in there. I could be wrong, but counting on antitrust or something or a breakup is not something we find interesting in this market.
Now, you are friendly with Joe Biden. I know you've talked with his campaign over the last couple of months. How scared do you think Wall Street should be of how tough he'll be on market regulation, on tech regulation, on taxes?
Well, I think that, first of all, I think that the incoming administration is not going to be anti-market. I do think they probably will be tougher on bad actors in the market. I've dubbed the current environment the golden age of fraud. And I think, and I'm hopeful that the incoming administration will toughen the cops on the beat, if you will, in the marketplace. But that should be a good thing. I mean, that should be something that everybody wants.
Do you find that the incidence of fraud candidates is correlated with the multiples of the market, given where we are right now? I mean, does the current environment compare with 2000 or 2007 in terms of opportunity sets?
Oh, it's much greater today. I mean, so I teach a course on the history of financial market fraud, and one of the things we teach, Scarlett, is that the fraud cycle follows the financial cycle with a lag, and the longer a bull market goes, the more people's sense of disbelief erodes, and they begin to believe things that are too good to be true. And I think we're seeing that now more than we've probably ever seen before, in terms of the willingness of markets to buy outright frauds, or where there's evidence of fraud, or even where the evidence of fraud is sort of laid out for you. I hearken back to the Wirecard episode from earlier this year as a company we were short in Germany. And for a good, better part of 18 months, short sellers and journalists were pointing out a fact pattern that almost inescapably would lead you to believe that there was wholesale fraud going on at this company. And it wasn't until the company itself admitted the fraud in June of this year that the stock collapsed from 100 euros to single digits. And prior to that, almost everything you needed to know was actually out in the public domain on this company. And we're seeing it similarly today in a number of our shorts that we think where there's fraud, particularly some of the Chinese frauds. It is absolutely just remarkable to me as to how many instances of outright fraud are sort of hiding in plain sight. And investors continue to buy the shares of these companies because the companies themselves haven't admitted it yet.
What does it say about the current environment that you have to wait until the company admits fraud before the rest of the market believes it?
I've never seen anything like that. That is new. And that's why I think, that's why I've dubbed this the golden age of fraud, in that prior to this, companies that are credibly under a cloud because of evidence would begin to underperform the markets rather dramatically. And now that's not the case, and in many cases these companies outperform the market until the companies admit the wrongdoing. And that's a really, really new phenomenon, and that's one of the reasons why I think the risks in this market are much higher than people think. Because if people are willing to believe criminals who until the criminals themselves admit the crime, you have a very speculative market.
So your specialty is looking for legal fraud, where companies may be following existing accounting rules or regulations, but they're exploiting them with an intention to deceive. However, it's still legitimate. It's still, the lawyers have checked off on it. The accountants have given their okay. how different is that from gaming the system, which is generally something that is seen as a good thing on Wall Street?
The prime example of legal fraud was Enron, right? Where everything they did was legal under the accounting regulations, and they were not prosecuted for accounting fraud. They were prosecuted for lying to their investors. And so it just depends. It depends on the magnitude of what the company is trying to pass off as legal under the accounting or regulatory rules. And is it material to the business? And then if so, when does the market care or does it care? And but the poster child of that more recently was Valeant Pharmaceuticals, which went from $10 to $260 back to 10 because it was convincing investors that its pro forma cash earnings per share were $12, and in fact they were losing money. And so, but nothing they did was illegal under the regulations or the accounting rules.
So how much of your current